Good morning, everyone. Welcome to this update for global stocks and commodities for the 9th of October. It was a really big week of disruptions, both in currency and in commodity markets, and it really just underscores how stretched the global financial systems are and how stretched some individual players, like Deutsche Bank, for instance, are in the marketplace. And I think bursts of this sort of volatility, where we saw the British pound fall by 6% in a matter of minutes, which is just extraordinary. And we also saw $50-$60 come out of the price of gold as well. These are all forced liquidation events or market manipulations, whatever you want to call them. And I think they're going to be a feature of the landscape going forward. You can't continually stretch financial systems as central banks have done for the last 7 or 8 years and not have some unintended consequences. And I think we're seeing those now. So let's get on with this week. I am going to make a bit of a change to the format of these videos. I've had feedback from the many people that watch these videos every weekend, and some love the detail and the longer length, which is generally between 20 and 30 minutes. Others have said to me that sometimes they find it a bit long. They don't have time to watch something that long. So basically, what I'm going to do is where there's nothing terribly much to report, the videos will probably be more of a 8 to 12 minutes in length, and they'll just cover basically a summary of the week and my strategic thoughts on how things are unfolding. But when something is occurring, and we saw plenty of disruption through the week, so there's a bit to talk about this week, then I'll provide the extra detail and cover it that way. So hopefully that will suit all the viewers of this video. Now, as I mentioned, really large currency and commodity moves, and we saw just huge moves in the British pound and also in gold and silver. And I'll come back and talk about gold and silver a bit more, because I think that is either forced liquidation or manipulation, or a combination of both. And it is not indicative of a change in sentiment towards the sector. I think that's the key point that I want to make. Now, whilst I'm expecting that we're going to see more and more bursts like we've seen in the last week of sudden moves, the high quality stocks will sail through it at the end of the day. If you buy great stocks that are growing their earnings rapidly, that have got really good balance sheets, and you're buying them at a reasonable valuation, then they're going to do just fine. However, there are methods that you can use that will enhance your returns, so you can do better than just buying those stocks at any old time. And also, that's going to lower your stress levels, because if you can take profit at appropriate times and raise your cash levels, then it's much easier to get through these periods of disruption that I'm sure we're going to continue to see. This is a case in point on the British pound. There's certainly been a trend there. This is the Australian dollar against the British pound, basically since a year ago, and you can see that there's definitely a trend there. It's moved up from around 48 to about 62 at the moment, so definitely a strong trend, but quite a decent move this week as well, with that spike in the spike down in the British pound. So if you're thinking about going to the UK, then it's from Australia, it's getting more and more attractive. Looking at American stocks, the S&P was down by 15 points on the week. It was another pretty lackluster week, really. Not a lot happening. Market sentiment remains definitely risk on. If you look at the sectors that are outperforming, and you look at the breadth of the market, and you look at all those various indicators that I look at, there's no question that market sentiment remains risk on. However, it's been 3 months now since this breakout occurred on the 11th of July, above the previous all-time highs, and the market just hasn't got on with it, and it's really lacking momentum. And that's a little bit of a concern. So we've certainly got some conflicted signals. The market is definitely in many ways taking a bullish stance, but the prices just aren't really making any headway. It's like everybody's waiting to see what's going to happen, and it could be related to what's happening in Europe with the banks. It could be related to the US election result. There could be a number of reasons. But let's have a look at that particular price chart. So this is the S&P. Here was our breakout here on the 11th of July. So just pan back and take a bigger grab here. So that was a significant breakout because these highs were formed back in 2015. So quite a significant breakout. And you can see we moved up initially, but since then we've come back. We've retested the breakout, which is normal. So that's all perfectly fine technical behavior. But it just hasn't gone on with it since then, and it's just been stuck in this region. So quite frustrating. But if you look at the Nasdaq's still looking very positive. It's at all-time highs, and if you look at the Russell 2000, then you can also see it's just a whisker off its all-time highs as well. So the areas that you would expect to turn down first, if we're in a topping pattern, certainly haven't done so. Just while I'm here, let's look at the Australian index. Quite a solid week in the Australian market, but really it was all just down to banks and energy, and certainly looked to be running out of puff towards the end of the week, that's for sure. The Aussie dollar was down below 76 cents again, and it's really been stuck in this range now between 74 and 78 for some time, and it's really just moving in tandem with the US dollar. The ASX 200 index managed 31 points on the week, and it was energy and banks that led the way. Now, one of the big disruptions of the week was in precious metals. We saw gold fall by $58, or about 4.4%. That was the biggest weekly move in 3 years, so it certainly was significant. There is all sorts of evidence coming through in the last 24 hours about what was behind it. And, I guess analysts love to try and put a label on all these things. To me, there's certainly enough evidence of forced liquidation, and there is certainly a strong case that Deutsche Bank received a major margin call and basically just had to sell a lot of things that weren't nailed down, and that caused a significant disruption in the market. It also occurred at a time when the Chinese were on a week's holiday, so they would typically be a buyer. And I can't help thinking the timing is very, very convenient. We're about to enter the Indian Diwali festival season when gold buying increases, and so for all those reasons, I think there's probably an element of both in the move. But look, the key point about it is, whatever the triggers were, the key point about it is that this is just short term. There has not been a shift in investor sentiment, and it's investors that sustain the bull market in the long term. The speculators, which is what this is about in the last week, the speculators move the market in the short term, but they do not create or sustain bull or bear markets. That's for investors to do. And as you'll see in a minute with the chart that I'll show you, investors didn't move. They didn't budge last week. This was all speculator activity, and therefore is very short term in nature. So we'll see a chart in a minute where the investors in the ETF market basically held quite steady. And in fact, if you look at the gold holdings, this is something that I track every day. I look at the holdings of physical gold in GLD, which is the world's largest ETF, and represents about 40% of all ETF precious metals ETFs in the world. The gold holdings in GLD actually rose by 11 tons on Friday night. That was a big spike, and the levels, if you can download a spreadsheet which shows you the daily holdings in gold going back to 2004, and over the last 2 or 3 months, the holdings in GLD have hardly moved. So that means that investors are basically sitting pat. They haven't added to their holdings, but equally they haven't seen fit to liquidate. And normally you would see a liquidation after such a massive move, but to see the holdings go up 11 tonnes on Friday night to 958 tonnes was, I think indicative of what's going on. The fundamental drivers remain in place, all the things that I've talked about over the last 6 or 8 months. So they're all still in place. Is this a bottom? Look, I'm not sure. There's certainly a technical level for gold at $1,250 an ounce, as we'll see in a minute. But when you've got forced liquidation going on, that tends to override technical levels and longer term fundamentals. Major players just have to sell, and that's all there is to it. So that makes it a little bit more unpredictable as to where the bottom might be. So my advice is that, as normal, stocks will lead the way in both directions. And that's why I've been a little bit cautious on the sector throughout this corrective period. When gold and gold stocks turned up after only 2 to 3 weeks of correction, I said at the time, this isn't long enough. It might be the bottom, but it's not long enough for the typical correction. And stocks were certainly, telling us they turned over again, and were telling us that eventually gold would break down. The same will happen in the reverse direction. Gold won't pick up again, and we'll see gold stocks move first, I believe. And so therefore, I think it's advisable to gain some confirmation that gold stocks have bottomed and are turning up. Now this is a chart that I think is really, really important. The white line is the price of gold, and you can see the plunge in this chart is a day or so old, but you can see the plunge in the gold price in the last 48 hours. But the blue line is the holdings in ETF in tonnage, and you can see that it's just been flatlining it now since July. So we had a very strong rise from January, and it's just continued to basically flatline over the last couple of months. So I find that quite encouraging. Let's take a look at the gold price. This is gold on a daily basis, and you can see I've put a Fibonacci scale on here from the rise from basically the bottom, which occurred in December of last year, and the peak that we achieved in July of this year, and we've just come back to the 38.2% retracement, almost spot on, which is at 1250. So far, technically, it's behaving itself. A pullback to the 38.2 or even to the 50% level. If gold were to come down to 1212, that does not negate the bull market setup. A 50% retracement, it happens all the time in ongoing bull markets. So don't panic, or don't think that things have changed if we get another leg down in the gold price, because it could well happen yet. Silver also copped a bit of a belting, but did turn up a little bit on Friday night. Let's look at GDX. So I've been looking at this chart now for a few weeks. I had 2 support levels marked. We've clearly broken the first support level. We've got the second one down here at around 2212 on the GDX index. So if you want to track that one, so 2212 is a support level. I wouldn't be too keen on seeing stocks fall much below that. And we closed at 23, so about another 5 or 6% downside would be tolerable in that market. So my strong advice would be to wait for confirmation of stability and the fact that it starts to turn up. Turning to other commodities, Copper slipped a little bit, but that was really just currency movement. Crude oil was definitely firmer, went above $50 during the week, and then finished just a few cents underneath it. And stocks in the energy sector continue to show some good positive signs, as members would know. And we've got a couple of good trades and investments underway in that sector. So just to wrap it up, the overall strategic approach. Markets are unpredictable at the moment, as I said at the start. We've got so much stress in financial systems that it's, any little thing can disrupt. And if you get forced liquidations occurring, then the markets can move quite quickly. That means that gaining good entries is really vital. That's the first point. You don't want to be chasing prices, and you don't want to just pay any old price. But gaining good entries requires patience. And so to me, the only sensible way to play the market at present, and probably for the foreseeable future, is to have multiple opportunities, either have multiple bull markets to pursue or have a very wide array of potential stocks that you want to buy. Don't just have a couple that you're focused on. So my really, really strong advice would be to only buy on your terms. Have a lot more stocks potentially to buy than what you have money to buy. And that means that you're not tempted to chase anything, or you're not waiting on anything in particular. I talk to lots of people who fall into the trap of trying to buy. They make up their mind that they want to buy a certain stock. And if the price doesn't come back to a certain level, then there's a tendency naturally to want to chase that price, because you kind of get your heart set on buying that stock. And I think in these sort of markets, that's really dangerous. Understand what buying on your terms means, and have enough stocks so that you just wait until it comes back and falls in your lap, and that's when you buy it. And if a particular stock that you want doesn't ever get back to that price, well, don't ever buy it. It's about as simple as that. This is about building wealth and making money. This is not about owning a particular stock. So I'd really encourage you to, to try and shy away from that tendency to want to own a specific stock. Now, I've also had a few questions about the fund that I run. There is an option there. A lot of people weren't aware that I had a fund. I can trade for you. There may be circumstances under which you may prefer me to do that. So I just thought I'd touch on this very briefly. Basically, what I'm doing is I'm going wherever the best opportunities present, consistent with what I've just said. I've got a model, I've got a pricing structure, and I've got an awful lot of targets, and I buy what falls in my lap, and I'm buying under my terms. I'm working in both the American market and also the Australian market. But of course, in the American market, you can, through ETFs, you can actually gain exposure to a lot of stocks in Asia and Europe as well, as appropriate. I'm pursuing the sectors that have the strongest fundamental drivers and the highest earnings visibility into the future. So that's the core model that I use. And I'm also pursuing unfolding bull markets, and we've got one of those with China stocks. We've got one of those obviously with precious metals, and I think eventually the energy sector will kick in as well. So it's a matter of getting that asset allocation right. It's a matter of moving your exposure around and taking profits when they present, pulling back, making sure you're cashed up. There's quite a bit that goes into it. It's an individual account structure set up, and that allows you to view your holdings in real time. So if you like, you can just follow along and allow me to do it for you and be a part of it without having to actually make the decisions. So if anyone is interested in that, or in fact is interested in the membership side of the business, then there's my contact details. We've just launched a new website. So if you haven't been there before, go and check out the new website. And I'll be back with you next week. Cheers.